Hello, fellow Rebel Capitals. Hope you're well. Got a new office, got a new studio, and the internet here is a little iffy right now. We're getting that fixed tomorrow. Hopefully, we can get through this live stream, but we've got a lot to talk about. The Atlanta Fed GDP Now indicator has plummeted again. I know you're probably thinking to yourself, okay, George, I saw the video last week where it went from positive 2.3% down to 1.5%, or negative 1.5%, excuse me. And you were trying to think that through, and it's likely because of a trade deficit, et cetera. Okay, but now it's gone down even further. We're going to dive into the details here in just a moment. Also, we've got the markets plummeting. So there's that. Bond yields collapse. And then crypto, my goodness gracious. You want to talk about some volatility with Trump coming out with all of his tweets. His sons were doing the same thing, a massive pump on Sunday. And then today we get the old rug pull, as you would imagine. So first and foremost, let's get into the Atlanta Fed GDP. And actually, before we do, let's go to Investopedia and find out from them exactly how GDP is calculated, because I want to understand that first, and then we look at what's happening with the Atlanta Fed GDP forecast, and then we say, okay, why is this happening? Is it just the deficit, or is there maybe more to the story? And even if it is the deficit, is that a good thing? I don't know. We'll discuss that in a moment. So Josh, let me know about the audio here. I'm going to try to play this video. Mellow music. Hear that?
Good to go.
Okay, thanks.
The letters GDP are flung around often by the president, the Federal Reserve Board, journalists, and many others. They stand for Gross Domestic Product, which represents the overall market value of all the goods and services a country produces. In a way, it's like a price tag on a country's output, and it measures the size of the economy. The price is determined with the following formula: C plus G plus I plus NX equals GDP, where C is the nation's private consumption or consumer spending, G is the sum of government spending,
Boo.
I is the sum of businesses' capital spending, and NX is the nation's total net exports, exports minus imports. GDP is an important number because it indicates whether a country's economy is growing and expanding or shrinking and contracting. It also gives important information about how the introduction of new products and services or the improvement of existing ones affect demand. This data helps to plan future product development and improvements.
Okay, so first thing I want to point out is going back to, we'll just pause it right here and try to close this advertisement. So we get it, right? Private sector spending, government spending, basically spending or investment by business. And then you've got to add or subtract what's going on with the trade deficit or the trade surplus. Because what we're trying to solve for, and obviously it's a very imprecise number, but what we're trying to solve for is the goods and services that are produced in the United States. So obviously, if you have imports coming in, well, then that's not being produced in the United States, but yet it's going to be caught in the retail transactions, right? Because if we've got all this stuff coming in from China, you're buying it at Walmart. Well, when you buy it at Walmart, that transaction is going to be factored into GDP. That's the C part of it, the consumer spending or private sector spending. But we didn't produce that here, right? So what we have to do is we have to subtract that, and that's where we look at the trade deficit, okay? But if there's a trade surplus, then obviously you would want to add that to GDP because we're so productive that we're producing so much stuff that we can actually export the additional productivity to other countries. And so that was produced in the United States. So we would want to add back a trade surplus, and then we would want to subtract a trade deficit. Because again, what we're trying to solve for is the stuff, goods and services that was produced in the US domestic economy. How efficient, what was the productivity that we had for any given time frame? So now let's go over to the Atlanta Fed. We've got that cleared up for everybody. I'm going to switch up the screen share. Okay. And let's see what is doing. What we talked about last week was the GDP right here at, call it 2.3% roughly. And then we just get this Wile E. Coyote moment where it plummets. Now, most people, and even when I was thinking this through on the live stream, we were just looking at the trade deficit. It's like, wow, okay, the trade deficit just came out. That's probably what did it. But then I was like, well, yeah, but I mean, how did they not know there was going to be a trade deficit? And it's not like the month prior we had a trade surplus. I mean, the month prior it was like 120, and then it went to like 150 billion. So 150 billion is a huge number. I think it's the biggest trade deficit we've ever had, but it was trending in that direction. So why was that not picked up in GDP now? Like it doesn't just happen out of the blue. That was the first kind of head scratcher. But a lot of people were arguing that it was a nothing burger because it's just a result of all these companies trying to front run tariffs, and that makes sense. There's obviously a lot to that. So these companies are worried that, okay, crap, I've got all these input costs or all these inputs that I'm importing in from Mexico or China or Canada or whatever to create my widget. And if Trump puts on a 25% tariff, then I'm going to have to pay an additional 25% for this input. I don't want to do that. So I'm going to go ahead and load up on inventory right now just to try to front run those tariffs so I don't get caught up holding the bag. And so again, that makes a lot of sense. Now, should we subtract that part of the deficit from GDP? Probably not. I mean, I get the argument why you wouldn't, but this is kind of an anomaly. When you look at things like the tariffs or surveys of sickness or anything like that, it's not like this happens every single month, or it's not like it happens every single year. So I think the way they're doing that, they're calculating it now. I mean, again, it's a very imprecise number, but I get why they've got the formula they do. But now what's fascinating is just today, okay, so now you can't blame this one on the trade deficit. We go from negative 1.5% down to almost negative 3%. So and again, I want to restate this for everybody. This is something that you cannot blame on the trade deficit because it happened after the news came out about the 150 billion deficit that we had for the last time that was calculated, I believe last month. So this is what took us from negative 1.5 down to, call it almost negative 3, was something else. And I don't know how, if you're bullish here, I get how you could dismiss the first move, but I don't know how you can dismiss the next move, especially when you combine that with what's happening with the curve, the near-term forward spread, long into the curve, everything that we talk about on this channel. Let's see, does it give us an exact? Okay, here you go. Latest estimate, minus 2.8. I mean, we'll have to see how, or actually, let me read this. GDP Now models estimate for real GDP growth in the first quarter of 2025 is negative 2.8% on March 3rd, down from negative 1.5% on February 28th. After this morning's releases from the U.S. Census Bureau and the Institute for Supply Management, the nowcast of first quarter real personal consumption expenditures growth and real private fixed investment growth fell from 1.3% and 3.5%, respectively, to 0.0% and 0.1%. So I think this, and again, I'm just reading this for the first time, guys, but this is, I guess, the rationale for why they took it from negative 1.5 to negative 2.8. And it's, again, because of personal consumption expenditures growth, because that fell from 1.3 down to 0, and real private fixed investment growth fell from 3.5 down to 0.1, basically 0 as well. So, I mean, straight off a cliff, especially for the fixed investment growth. I mean, now let's couple that with what's happening in the markets. And well, first and foremost, I don't think we've been talking about oil enough. And it's really, to me, a reflection of what's kind of happening, not just with the supply side, which gets all the news, but really the demand side of the equation. And today we're right back down to 68. And so you say, well, George, 68 isn't that bad of a number. I mean, that isn't recessionary in and of itself. And I totally agree. But you got to think about what OPEC is doing. Right now, they have production cuts at the same level as they had during the GFC. During the GFC, they've got almost economic depression level production cuts. So just if they had the normal production, I mean, where would we be? Sure as hell not 68. I mean, we might be sub 50. And if we're sub 50, just from an investment standpoint, that's when I'm getting very excited about buying oil stocks, because it's getting into that range where it's starting to get cheap adjusted for inflation, just on a side note. But I think it's crucial that when we're looking at that 68 number, we're factoring in those production cuts that are much, much higher than you would normally see. And then you got to think about, okay, where would we be if this was normalized? And then again, maybe 50, maybe lower, but we definitely be at areas where if the headline price moved to that point, everyone would be talking about the demand side of the equation and how that is looking like it's trending towards recession. Just out of curiosity, what's Dr. Copper doing? Okay, well, Dr. Copper's hanging in there. So again, we want to look at the good, the bad. We want to look at a complete picture here to do a thorough analysis of what the probabilities are. And copper's hanging in there. So if we are right on the brink of a recession, you would, or I would expect copper to be diving lower. But look at what happened in the bond market. Down 7 basis points today. I mean, this is really mind-blowing stuff. Let's look at a chart of the 10-year Treasury, just going back a couple months here. Right about the inauguration, we were at 4.8, and now we're down below, well, it just ticked down again. We're right about 4.15. So, I mean, we've had a drop of 65 basis points in 2 months or so. And for those of you who are new to the channel, why is that important? Because this isn't just a 100% guarantee that you're going into a recession, but what it is showing you is what these huge banks, hedge funds, pension funds, what they're doing with their balance sheet capacity, because they've got options. So let's just think this through. It's all about risk reward for these guys and gals. So let's just say they have two options. One, they can lend into the real economy at 6% or the global economy. Okay. Or they can buy a 10-year Treasury yield at, let's just say 4.3. All right. Well, Boy, 6 is a lot better than 4.3. But the 6 comes with additional risk. So if the perceived risk within the economy and the future projections, as far as the risk, is very high, then the delta between 6 and call it 4.3 isn't attractive enough. They're not being paid enough to take the risk because the risk is extremely high. Therefore, what are they going to do? They're going to use that balance sheet capacity and they're going to buy treasuries. They're going to likely buy the long end of the curve, which is why you see it go from 4.8 and just absolutely plummet down to 4.15. And you say, well, George, it's kind of predicting that the Fed's going to cut rates as well. Okay, that may be a part of it, but why does the Fed cut rates? The Fed's not going to cut rates if the economy is booming. I can assure you. The Fed cuts rates in response. And remember, through past cycles, they don't cut rates in to get ahead of the stuff hitting the fan. They cut rates in response to the stuff hitting the fan. They're always behind the curve, in other words. So when you're seeing this price action, it doesn't mean that, oh my gosh, there's a 100% guarantee that we're going to have a GFC tomorrow. I'm not saying that, but you have to include it into your analysis, and you can't just include the price going up or the yields dropping. You have to understand why they're dropping. Why are they dropping? And a lot of people get confused here because even when you listen to the quote unquote experts, you'll hear, oh, well, it's because Scott Bessent or Janet Yellen, the Treasury, isn't issuing enough at the long end of the curve. You can know right off the bat that's nonsense, because what impacts, or what a lot of things impact it. Obviously, there are thousands of variables, but the main driver is going to be growth and inflation expectations. And another thought experiment is, let's just say right now that based on that risk reward, the market is saying, okay, I'm liking 4.15%. Okay, great. And remember, there's an inverse relationship between the price and the yield. So let's just say right now, the price of this treasury is $100 and they're buying it all day long at $100. Okay, well, what happens if Scott Bessent comes out and issues $1 trillion at the long end of the curve tomorrow or throughout the next week? Okay, well, likely the rates are going to go up. In other words, the price is going to go down. Well, the whole reason these mega institutions, financial institutions, were buying is because they liked it at 100. So if they like it at 100 because of growth and inflation expectations and the risk reward that we talked about before, are they going to like it at 90? Are they going to like it at 85? Of course they are. They're going to like it even more, assuming that the growth and inflation expectations don't change. So if it goes from 100 to 85, what are they going to do with their balance sheet? They're going to pile in, because now all of a sudden, the risk reward for that asset looks even more attractive than it did before. And then what's that going to do to the price? It's going to drive it straight back to 100 where it started. In other words, it's going to drive the yield right back down to 415. When you think about it in these terms, it starts to make sense as to why supply, oddly enough, it's very counterintuitive, but why supply really doesn't drive yields. It's much more about growth and inflation expectations. Okay, so now let's go over to the stock market, which usually I'd want to pay more attention to the dollar and the 10-year treasury, but I think it's very important we pay attention to the NASDAQ and the S&P right now, because we could be seeing a narrative change. And if you're playing the stock market, I think that is the most important thing. It has obviously nothing to do with fundamentals, but it's all about the narrative. And honing in on what the most important part of the narrative is, all about NVIDIA, because it's like a daisy chain, or it's like almost an inverted pyramid, right? Where at the bottom of that inverted pyramid, you've got NVIDIA. And then the next level is Mag 7. And then the next level is the S&P 500. And then the next level is basically the US economy. And it's all just teetering on NVIDIA, right? So if you take out that NVIDIA Jenga piece, what happens to the whole thing? It falls down. We've got all our eggs in the NVIDIA basket. And that's why when DeepSeek came out, I did a whiteboard video on how this could be a game changer, not just for AI, but for the entire stock market. And note, since that time, what has NVIDIA done? It's crashed. And what has the NASDAQ done? It hasn't crashed, but it's gone down substantially. And you knew that was going to happen. And how did you know that was going to? Because all I have to do is look at the comments of my videos. Whenever you get the vast majority of people saying, oh, you're too bearish, you're too bearish. Oh, the stock market's going to go up forever. Oh, this has nothing to do with NVIDIA, blah, 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 blah. You know darn well you're on the precipice of boo. You use that as a contrarian indicator. Okay, so let's go. Well, let's go to the homepage here. And then, but the opposite is true. When people say that I'm not being bearish enough, then that's the time to buy. So Dow down 649 points. But what's really interesting is what happened just at the tail end of the day. So check out a day chart. And you see, we just collapse into the close. Up a little bit there, I guess, at the absolute close. But throughout the day, just down, 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 down. And same thing when you look at the S&P 500, down 1.76%. And NASDAQ leading the charge down once again, which means risk off to me, risk off. And it's down almost 500 points, 2.64%. Oh, I'm sorry. Russell 2000 is actually leading the collapse, if you want, not the collapse, but it's leading the plummet, let's say. And that's at negative 2.81%. So why is this important? You know, is it a big deal that the S&P is down 1.76%? Not really. I mean, it's a rounding error. It's probably just back to where it was a couple weeks ago, or maybe a couple months ago. But what's important there is the narrative shift, right? Because we're getting economic data that would suggest a softening of the economy at the very least. And in the past, for almost as long as I can remember, that would mean the stock market goes up because bad news is good news. Because if we get bad news, well, that just means the Fed is more likely to cut rates. And when they do cut rates, they're more likely to cut rates more times, let's say throughout 2025, than the market had anticipated, let's just say prior to getting the softening data. So that's why in the past, it's like, oh, wow, the unemployment rate's going up. Fantastic. Let's buy. This is a buying opportunity because we know the Fed's going to, they were going to drop to 4%, but now, I mean, they might drop to 3.5. And as long as the Fed's cutting, no matter how massive a recession or depression, people don't even think about that part. They just get hyper focused on the Fed cutting rates. And if the Fed cuts rates, well, then that means you buy because the stock market has to go up. It's like, well, what if they're cutting rates because we're going into a recession? They just try to sweep that one under the rug. But now it seems like when we're getting the softening data, when we're getting things that are a little concerning about the real economy, we're seeing that actually play out in the market where bad news could be, maybe not, but it could be turning into bad news. And when you go into a bear market, then it's the opposite, right? In a bull market, what we've seen for, who knows, as long as I can remember, it's like bad news is good news, but good news is good news. So whatever the news, buy. But when you go into that bear market, and I'm not saying we're going into one now or we're in the process of, or at the beginnings or the middle or whatever. I'm just saying we could be. But in those bear markets, it's the opposite, right? Where bad news is bad news, but good news is bad news. And it's just the time frame is far more condensed in a bear market because, as you guys know, the bull market takes the escalator up, and then the bear market takes the elevator down. Now let's go into gold. And gold up almost 2%. And they always say a weaker dollar. I don't know. It's tough for me to argue that the dollar's weaker when it's still at 1 point or 105 or whatever. Let's see what it is right now. It's 106.5. I mean, I don't know. I don't think the gold is really responding to the dollar. Maybe, but I think gold is more responding to just uncertainty. There's just so much uncertainty, and the more uncertainty we get, the more people are like, look, I want something with no counterparty risk. Give me physical gold. Give me physical gold. We looked at oil. Now let's look at the rug pull here. So Trump comes out. Let's see if I can find the tweet here. I'd like to find it on Truth Social. Hopefully they post it here on Reuters. Let's see. No, they don't have the actual tweet or whatever the hell you call it on Truth Social. But basically what happened, I'm sure you guys know this, but if you weren't paying attention, on Sunday, again, the perfect time to do it if you're trying to pump something. I'm not saying Trump is, but there's obviously something going on behind the scenes there where someone that has his ear, or maybe someone he owes a favor to, or I don't know, something like that, is saying, hey, do me a favor and go ahead and tweet about this on a Sunday. Why on a Sunday? Because the float's low. The float's, the volume is extremely low. Not the float. The volume is extremely low, and the float's low for that matter in Bitcoin. And so you're going to get more volatility, the upside and the downside. And so, hey, let's, low volume, go ahead and announce this. Then it's going to rip higher, and it's going to rip higher than it would have if you would have done it on a Monday during trading hours. And I'm just going to sell into that. And I'm just going to dump all my garbage, XRP, whatever it is. And what I think was very interesting is the first tweet talked about XRP. It talked about Cardano. It talked about Solano, if I'm not mistaken. And then it said nothing about Bitcoin or Ethereum. And then a few minutes later, an hour later, then you get a tweet saying, oh, and I love Ethereum and Bitcoin too, exclamation. It's like, come on, man. This is so obvious what's happening. It's like someone either tweeted for him or he tweeted, and it's just, what do I say? Oh yeah, okay, this, and he like forgot to write down Bitcoin and Ethereum. And then like an hour later, he's like, he's getting all these calls being, hey, Trump, you said that you would pump Bitcoin too. You owe me the favor. You said you'd pump Ethereum. He's like, oh yeah. Shoot, I forgot about that. I'm sorry. I'll go ahead and do another tweet. And that's when he goes, it's so fishy. And I know a lot of people, whenever I talk about Trump, I always get like tons of downvotes because it's either people think I'm a Trump fanboy or they think I've got Trump derangement syndrome. And oddly enough, it's for the exact same comment. Like they'll reference a comment that I make, and one group of people will say that comment proves I'm a fanboy. And then the other group will say that exact same comment, that exact same part of the live stream proves that I have Trump derangement syndrome. Like, can we please just be objective for once about this? Can we please try to be objective about and non-emotional about the politics? If we just set the tribal stuff down until we get done analyzing kind of what's happening from the standpoint of markets, the standpoint of risk, the standpoint of the economy, and then once the live stream's done, then we can go back to being tribal again. That's not going to happen anytime soon. And another thing that really rubbed me the wrong way is I saw a tweet from, I think it was Eric. It was one of his kids saying, this is a genius move. And it just, the fact that he did this on a Sunday is pure genius, because it just proves that, this is the direction financial markets are going. And I'm like, come on, man. Can we just be honest? You're not saying that because you think it's genius. You're saying that because you're just trying to pump it even further when the volume's extremely low, because you're trying to help the cause here. And what really frustrates me about that is, number one, they're just not honest about it. And number two, people, the retail investor, the average Joe and Jane, they get caught up in this and like, oh my gosh, he's doing a crypto reserve or, crypto strategic reserve or whatever it is. And then they're just buying. And then what's happening? All Trump's buddies or whatever are selling into that. And then today they get the rug pull. Now, it's true that if you would have bought right at the absolute bottom, you'd definitely still be ahead. But most of the retail people, they're not doing that. They're just they're seeing the headline, they're seeing the tweet, and they're just launching over to their Robinhood account or however the hell they buy it. And then they're just, doing everything they can to get in because they think that this is going to the moon, baby. Everybody's talking about it. And then, the next day, and also too, I think I was listening to Schiff talk about this, and he was making some great points, some very, very good points. And one of the things he said is that he actually understands why there would be an argument to put Bitcoin in the strategic reserve. He says he doesn't agree with it. Obviously Schiff isn't a fan of Bitcoin, but he's like, I get the argument at least that it's digital gold and we have a gold reserve, we have an oil reserve. So, okay, why not have a digital gold reserve? But he said, what is the argument for putting Solano in there? Or Solana, I'm sorry, Solana. What's the argument for that? Why does the United States need that in some sort of strategic reserve? Why is the government even in this game? This is not for the government. I thought this was all about free market money. What happened to that? Right? And if you're going to put, and this is Peter's argument, which I think is rock solid. And he's like, if you're going to put Solana in there, hell, why not just put Doge? Why not put Fart Coin? Why not put Melania Coin? Why not put Trump Coin? And you notice that Trump said that, I think in one of those tweets, that Bitcoin and Ethereum would be the basis for the strategic reserve, but he left it open to put more things in there. And remember when the inauguration, when it was all just this massive pump and dump, and when even his preacher or whatever had his own stupid coin. And I said, I would not be surprised. Trump being Trump, it would not surprise me if he put his own coin and the Melania coin in the U.S. strategic reserve. I mean, even if he doesn't want to pump and dump it, it's just his ego alone. And I want to be clear, there's some things that Trump does that I love, but there's also some things that he does that I just don't like. And I know people don't like it when I'm honest, when I give my honest opinion about Trump, because they want me to take a side. They want me to be on some team but I'm sorry, that's just not me. And, so many people, they don't care about your opinion. They just want to hear their opinion come out of your mouth. Like my buddy Rich Cooper said so well. And if you're that person, that if you just tune into YouTube for confirmation, or because you have confirmation bias and you either hate Trump or you love him, just tune into a different station for a while. I'm not going to be offended. Go ahead and tune into a different station where all you hear is Trump is the second coming of Christ, or you hear that Trump is the Antichrist, whichever you choose, but just turn it into those stations, because you'll just hear it over and over and over. And then you'll get that, that confirmation bias will set in, and you'll be able to sleep better at night than hearing me go back and forth on some things I like and some things I don't like. Let's see here. I want to look at kind of the round trip. Let's use Bitcoin as a proxy here. Let's look at a 5-day chart. And yeah, so Bitcoin was just tankarooski on, looks like Friday. I mean, we're down, we got under 80. And, you know, I want to give Schiff another hat tip. Just how we were talking about what would the price of oil be if it wasn't for these kind of crazy production cuts or abnormal production cuts. Let me put it that way. And he made the exact same point with Bitcoin with Saylor. He's like, what would the price be if Saylor wasn't out there buying $40 billion worth of it? You know, I don't know, but it probably would be lower. Now, I think everyone should own Bitcoin, but not because of the price or the price direction. I think you should own it because it gives you purchasing power outside of the system. And, you know, look, at the end of the day, what is wealth? It sure as hell isn't cryptocurrency. It's not gold. It's not silver. It's not dollars. It's not money. It's goods and services. So when we're trying to look at the quote unquote crypto industry, which Trump called, I think, critical, the critical crypto industry, just ask yourself, what goods do we have today that are a result of this critical industry? What goods do we have today? What goods do we have today that Solana produced? I can't think of any. Now, we might have some financial engineering, but that's not what I'm talking about. I'm talking about the GDP stuff, right? Now, with Bitcoin, I like to look at it through that lens. I like to say, okay, does this actually have the potential to not just increase the amount of goods and services we have, but actually give us the opportunity to produce goods and services and transact for those goods and services completely outside of the system because it is totally decentralized? The answer is yes. And none of the others have that. So for me, that is reason enough to buy Bitcoin. And that's why it's the only one that's even interesting to me. And all the others are just basically either they're just inferior to the dollar or they have absolutely no utility whatsoever. And, you know, they're right up there with Dogecoin and Fartcoin and Butthole Coin. All right, guys, a lot of stuff going on, that's for sure. We're going to have to see how this GDP Now tracker plays out for the rest of this week. For those diehard fans here, I'm actually going to St. Bart's this weekend to visit my good friend Hugh Hendry and some other hedge fund managers out there. We're going to be talking to the infamous Steve. That's right. And then we'll do a webinar on Rebel Capitalists Live, probably at the end of next week for members. And I'll give you kind of the details as to what we talked about, kind of the main takeaways in terms of macro and investment strategies from this trip to St. Bart's. And Loma is saying, pitch your conference now. That's funny. Yeah, Rebel Capitalists Live. You can go there as well. But more importantly, whenever I go to St. Bart's, it's always a fantastic time, but it's always a huge learning opportunity for me. And, you know, I get to sit there and break bread and try to get into the thought process of not just Hugh, but all these other guys as well that are just extremely, extremely high level hedge fund managers and have been for decades. And I like to share that obviously, with the audience. So again, we'll do a webinar on that. I'm not sure when. I'll probably make the announcement on next Monday for that. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. We'll see you on the next video.